With massive layoffs in nearly every sector, weakness in manufacturing, car sales and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone. Happy Monday. Welcome back to the Daniela Cambone Show here on Stansberry Research, joined today by renowned economist and best-selling author of Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them. Please welcome to our show for the first time, Dr. Nouriel Roubini. Dr. Roubini, so good to be with you.
Great being with you today.
So we're going to cover a lot of ground, but first, I want to get your take on this domino effect impacting the banking world. You know, as we're speaking, First Republic now leading a decline in bank shares, coming even after regulators' extraordinary efforts to backstop all depositors in the failed Silicon Valley Bank and Signature Bank and offer additional funding. I mean, what's your take on the latest here?
Yes, what's happening is that there is a number of banks that have a very narrow sets of depositors. In the case of Silicon Valley Bank, was a bunch of tech firms. In the case of this other bank, you have wealthy individuals. And if you don't have a very broad, depositor base of millions of people, and your depositors are interest rate sensitive, then where there are rumors about potential losses, and all of these banks have some securities, and given the rising long-term interest rates, there have been at least $600 billion today of unrealized losses on the balance sheets of U.S. banks. And the U.S. banks have only $2 trillion of capital. So those unrealized losses are at least 28% of Tier 1 capital. In some cases of some of the smaller banks, is more like 50%. Now, the Fed allows you to keep these losses unrealized. You don't mark to market them, assuming that you're holding to maturity. But then that assumes that there's not going to be a run on the bank. If there is a run on the bank, then like in the case of Silicon Valley Bank, you have to sell those assets. You sell them at the loss given the unrealized losses, and then you have a hole in your capital. So I think the same thing has happened with Silicon Valley Bank, has happened with Signature Bank. There was a crypto bank, and now it's happening with a few other banks. That's what's happening right now.
Let's talk about parallels to 2008. Anyone who's followed your work knows that you had sounded the alarm on the '08 financial crisis 3 years before it imploded. Is the main lesson here that, you can't aggressively raise rates in a world saddled with $300 trillion in debt and not expect accidents to happen?
Yeah, that's a valid lesson because we live in a world in which there is too much debt, private and public debt. The sum of private and public debt as a share of GDP globally has gone from 100% in the 1970s to 200% by 2000. Last year was 350% of GDP and rising. In advanced economies, more like 420% of GDP and rising. And it's not just private debt, that is household, businesses, corporates, and financial institutions, but also public debt. And the public debt is officially only the official bonded debt, but there are also implicit liability coming from NG, unfunded liability coming from pay-as-you-go, social security systems, and Medicare. That's another 100% of GDP on top of 100% of GDP of official debt. So it was obvious to me, and I wrote about it extensively in my book, that once you have so much debt and central bank have to raise interest rates to fight inflation, eventually the zombies are going to go bankrupt. And that's what's happening right now. Depends on the country, depends on the sector, depends on the institutions. But what we're seeing right now is what I call in my first chapter of my book, the mother of all debt crisis, a situation where there is so much private and public debt that when central banks raise interest rates to fight inflation, you'll have a debt crisis. And we're only in the first innings of this major debt crisis.
Okay, and all valid points, and I have so many other questions now. I guess just going back to where does this domino effect stop? I mean, are we just going to have a clean out of these regional banks? Will it look like a system more similar to Europe where you just have less and less banks? I mean, how does this play out? Where's the end game? How does it stop?
Well, on one side, the Fed doesn't want to have excessive concentration of the banking system. There are already some very large institutions, JP Morgan, Citi, and Bank of America, and others that are too large. It has two problems. One is that they have market power. The second one is they're too big to fail. They're considered as being systemically important banking institutions. And the whole system after the global financial crisis was to allow an orderly, essentially, bankruptcy of financial institution. Now we've learned that even a small bank like Silicon Valley Bank going bust has contagious effects because many other banks look like similar. And effectively, the Fed has created a huge moral hazard problem right now by guaranteeing deposits of this bank, but also deposit of this signature bank. It was a crypto bank that did junky investment in crypto, and why now their depositors have to be bailed out. That's really the mother of all moral hazards.
Let's talk about a major curveball to this story. Goldman Sachs coming out saying they're now expecting the Fed won't raise rates. Could we see that pivot happening so quick?
I think it's highly likely. Yeah, I wrote yesterday that most likely the Fed is not going to increase interest rates at the next FOMC meeting in late March. And here's the dilemma. On one side, inflation is still too high, and the real economy with a very tight labor market needs the Fed to raise rates not only to 5.75, but all the way to 6%. But interest rates this high in a world in which we're in a debt trap imply the risk of a financial meltdown, a debt crisis. It's going to make the recession more severe, and a more severe recession is going to lead to more defaults. So there is a doom loop between an economic and a financial crash. So the Fed is damned if you do and damned if you don't. If you fight inflation, you cause an economic and financial crash. If you need to save the financial system, you don't raise the rates, then you're going to have a de-anchoring of inflation expectation, like the 70s.
Exactly. And I mean, we're speaking ahead of CPI. What happens if the numbers, come out showing they're still not winning the fight?
Well, regardless of what the CPI would show, could be a little bit stronger or weaker. I think that the economic data of the last few weeks and months, with very tight labor market, with core inflation being still very high, would suggest that the Fed should do at least 50 basis points at the next FOMC meeting. That was what Powell signaled just when he did this congressional testimony last week. Now this financial nightmare is occurring, and not only they're not going to do 50, not only they're not going to do 25, it's highly likely they're going to totally pause. So to have financial stability, you're going to create more inflation. Or if you want to fight inflation, you're going to cause financial instability. So the real economy and the financial economies are now contradicting each other in terms of what the Fed should be doing.
It's really interesting, and I've brought this up in past interviews. It feels, euphoric living under quantitative easing, right? Like you feel the pain under tightening. So is it the better of the two to live in?
Well, we created this mess of too much debt because every time that there is a bubble, the central banks don't do anything to stop it, and becomes another leverage cycle. And then when the bust occurs, people say, well, there's a systemic risk, now we have to bail out everybody. And therefore that you plant the seeds of the next cycle of more leverage, more debt in the private and public sector. That's why public debt. We've gone from 100% of GDP to 420 and rising in advanced economies. So there's always an excuse. There's a financial crash, there is a systemic risk, let's bail out again. By the way, what the Fed has been doing yesterday is backdoor QE, because these facilities are going to allow banks to essentially to borrow against their collateral, priced, by the way, at, how to say, not at market value, but at par value. Doesn't make any sense. The losses, anytime the Fed should be lending money, should be against good collateral with a haircut. No, they're going to pretend that these bonds are worth 100 cents on the dollar. That creates more moral hazard, more leverage, more risk taking.
So, all this to say, can we point the finger 100% at the Fed for the mess that we're in? We're 1 year into these interest rate environment, and it takes time before we really feel the effects 100%. So I guess the question is two-pronged here. Can they be blamed 100%? And two, how much more pain is to come?
The blame is both in the private and public sector. The financial system is reckless. After the global financial crisis, we regulated slightly better banks with more liquidity and more capital. But then there was a regulatory arbitrage, and the shadow banking system started to borrow like crazy without any standards, COV lights, leveraged loans, CLOs, and you name it. And the private sector, especially the corporate sector in this case, went on a borrowing binge. We have, trillions of dollars of highly leveraged debt of the corporate sector. So during the GFC was households and banks. This time around, these shadow banks and the corporate sector. So the private sector also has lots of biases that are leading it to excessive risk taking. But in part, that's fed by, of course, lack of prudential regulation and supervision of the financial system, easy money that leads to leveraging. 2 years ago, we had an everything bubble. Policy rates, were at zero, and everything, private and public equity, SPACs, mini stocks, day trading, crypto, private equity, growth stocks, tech stocks, bonds, credit, everything was in a bubble. And it took just gradually the Fed raising rates to fight inflation, not just to prick this bubble, but now have the risk of a systemic financial crisis.
Dr. Roubini, you've been warning about this perfect storm of recession, debt crisis, runaway, out of control inflation. So what is it an investor to do? Where is the safe play, if there is one?
Well, the traditional safe haven is government bonds, long duration. That's behind the 60-40 portfolio investment advice, or 70-30, or risk parity. That's predicated on inflation being low and the correlation between the price of equities and the price of bonds being negative. Risk on, risk off, growth, recession. When equity do well, bond yields are higher, price of bonds is lower, bonds do poorly, and vice versa when there is a risk off and there is a recession. But that assumes that inflation is low. When inflation is rising, like it happened since 2021, two things happen. The discount factor for equities, the dividends, is higher, the 10-year treasury yield, for example, and therefore equities correct. And long duration equities like tech, growth, VC kind of stuff corrects even more because the dividends are far in the future, and therefore they're more sensitive to a movement in long rates. That's why last year S&P fell 15%, while NASDAQ fell 30%, and lots of course, venture and other speculative stocks fell 50, 60, 80, crypto 90%. But then when yields rise, even if you don't have credit risk for safe government bonds, there's a market risk. There's no credit risk, but there's market risk. High yield means lower price. And last year, you lost more money on safe treasury bonds that fell, by 20% in price than you lost money on the S&P 500. I mean, I wrote about it in the fall of 2021. I said, inflation is going to be rising. That's going to be bad for equities. That's going to be bad for bonds. So the correlation became positive rather than negative when inflation is even gradually rising. Therefore, you have to find alternative assets that hedge you against the risk of inflation and debasement of fiat currency. The one that I would suggest are one, short-term treasuries that reprice with higher yield without having the price impact of a long duration bond, tips and other inflation index bonds, gold and other precious metals. They tend to do well when inflation is high and rising. One of the fallouts of this Silicon Valley Bank crisis is that now, as the Fed is going to pause, the dollar is going to weaken and gold is already going higher. And then you can also hedge yourself against inflation by having forms of real estate, infrastructure, farmland, commercial, and residential that are resilient to global climate change that tend to be a good hedge against rising inflation. So your traditional defensive asset that is long-term treasuries is a disaster. Last year has lost 20% of its value, and yield went only from 1% to 3.5%. Suppose that average inflation next few years is not going to be 2%, but say 6%, then 10-year treasury yields have to be at least 8%. Now they're at 3.5%. To go from 3.5% to 8%, you're going to have another 50% loss on your unquote safe treasuries. And there are $20 trillion equivalent of fixed income long duration in dollar, either treasuries or high yield or high grade or EM debt. So the bloodbath has barely started, and therefore any investor that has long duration dollar fixed income has to think about these alternatives: tips, short-term treasuries, gold, precious metals, sustainable real estate.
Yeah. And when you say the bloodbath has already begun, if we hone in and focus on markets right now, S&P, how much worse compared to last year?
Well, if we're going to have this year a hard landing, and I still expect a hard landing, because the Fed will have to keep on raising rates in spite of what happened with SVP to fight inflation, then we're going to have a recession. That recession is going to cause more defaults, because as income fall, people who have too much debt are going to default. And then the increase in bond yields and credit spreads is going to cause a recession is more severe. So there'll be a negative feedback between the real economy and the financial markets, with an economic crash leading to a greater financial crash, and a greater financial crash making the economic downturn more severe. Last year, even without a recession, just raising interest rates pushed the S&P 500 down 15%, NASDAQ 30%, and more risky assets down 50%. I would say even in a mild recession, the S&P 500 has to have a fall cumulatively of at least 30%. We're barely at 15 or less than that. And if the recession is going to be more severe, like during the global financial crisis, it could have a fall in equities of 50%. Maybe it's not going to be as bad as the GFC, but it's not going to be a plain vanilla recession. So something between 30 and 50, 40% cumulative. So we're still 25% to go.
And just a note, one more note on gold. I've seen in past interviews you've said you wouldn't be surprised to see gold move to 3,000 in the next few years. Have you moved that higher to a forecast, given everything that's happened in the last 24 hours?
Well, I haven't yet, but definitely the argument for gold was based on rising inflation, the debasement of fiat currencies, central banks wimping out, also de-dollarization, because the strategic rivals of the U.S., whether it's China, Russia, North Korea, Iran, and others, they have a lot of dollar reserves. They have to move away from dollar reserves, because eventually, in a situation of a conflict, the U.S. is going to seize those assets, like they did in Russia. And it's not just dollar, even the euro, the yen, or the pound, like in the case of Russia, could be seized. So the only international store of value that cannot be seized by the U.S. and the West, if there is a conflict, is going to be gold. Of course, gold not in the vault of the New York Fed or the Bank of England or London, but gold in the vault of some institution in Beijing or Moscow. So those are also trends that are going to lead to gold prices rising, with central banks of rivals and even friends of the U.S. who are worried about either inflation or secondary sanction. So that will lead the gold prices overall to go higher. When they're going to reach 3,000 and over which horizon to be seen, I don't want to be specific about it, but I would say gold has upside, of course, in this situation rather than downside.
And I don't think the specifics are important. I think you brought up central bank buying of gold. We saw record buying from central banks around the world before this disaster. It almost begs the question, what did they know?
Well, the central banks of countries that are strategic rival of the U.S. are going to gold because they're increasingly worried, that those dollar assets and reserves are going to be seized by the U.S. There's a saying, if I owe you $1 billion, is my problem. If I owe you $1 trillion, is your problem. And the Chinese hold at least $1 trillion of U.S. treasuries. And as the conflict between U.S. and China on Taiwan and so on could escalate from a Cold War to a hot war, the Chinese have to figure out how to diversify away from dollar assets, the same way in which the Russians had to diversify away from dollar assets. So one of the solutions, of course, is going into gold.
So that said, where does the US dollar go from here?
Well, the dollar has been overvalued, both on a fundamental basis, large fiscal deficits and large current account deficits. Japan and Europe have a fiscal deficit, but they have a current account surplus. But what was propping the dollar last year was the tightening by the Fed. Now, if you believe that the Fed is going to wimp out, as I believe so, because we're in a debt trap, and what has happened with SVP is an example of how, when you have too much debt and there is a systemic financial risk, the central bank is going to wimp out. Then if the Fed is going to pause, that means lower short rates like happened today, and lower dollar, higher gold. Therefore, the movement downward of the dollar will have to accelerate, and that's going to increase the dollar price of commodities, starting with precious metals. So the dollar has to fundamentally weaken from here on. You have twin fiscal and current account deficits, you have de-dollarization, you have strategic rivals getting out of dollar assets, and now you have effectively the Fed having to be on hold, if not cut rates, and they're doing already backdoor QE with the backstop of the deposits of the banks.
I want to talk geopolitics now, because I feel sometimes the danger of us getting swept up in all these headlines and just focused on what's happening in the banking sector is we tend to lose sight of what's happening in the rest of the world. I know you talk a lot about this. You say that we can expect perhaps more shocks to the energy sector, given the situation in Russia, Ukraine. But you also warn about paying attention to the whole, Saudi Arabia, Iran, Israel triangle here. Let's talk about the risks and dangers.
Yeah, we are definitely in a geopolitical depression. There is a hot war with the brutal invasion of Ukraine by Russia. That war is going to get uglier with the spring, of course. In the winter, the two armies were semi-frozen, but now the conflict is going to get much more nasty through the end of the year. In the case of the Middle East, Iran effectively is a threshold nuclear state, and that's an existential threat to Israel. And therefore, regardless of this rapprochement between Saudi and Iran, Israel is getting ready to potentially strike Iran this year. If that were to happen, of course, the massive shock to oil and energy prices, because the flow of oil from the Gulf is going to be somehow curtailed while the conflict occurs. And the Cold War between US and China is becoming colder by the day, and I think it's only a matter of time, how many years before eventually there'll be a real confrontation on the issue of Taiwan. So we live in this geopolitical depression. The implication is that, commodity prices are going to be higher. If Russia-Ukraine becomes worse, whether it's oil and energy, whether it's food and fertilizers, whether it's other industrial metals, like it happened last year, there'll be a spike. If there'll be a conflict in the Middle East, of course, there'll be a curtailment in the flow of oil and gas from the Middle East, and the same thing in Asia. So we're living in a world in which probably commodity prices are going to be much higher because of geopolitics.
Just to wrap here, we started talking about the banks, and I always like to give, tangible advice and info that the folks can use at home. And I've had so many emails, people calling me saying, I don't feel safe being in the banking sector. I want to get my money out. There's obviously a panic now. Folks who want to take their cash, move it into gold or anything else. What would you say to them?
Well, if your money is below $250,000, is guaranteed by the FDIC, is safe. If you have more than that, and you are in a large systemically important bank like Citi, JP Morgan, Bank of America, or similar, you'll be safe because those banks cannot be allowed to be collapsing. But if you're in a smaller regional bank, as we've seen, runs can occur, especially when the asset side of some of these banks is shaky because of exposure either to crypto or long-term treasuries or a very narrow deposit base that can be fleeing at any moment. So you're better off taking your money out. You can put it into a bigger bank. That's one option. You can put it in some safe short-term treasury mutual funds. That's going to be safe. Of course, you can put it into gold, but gold has some price risk. I think gold prices are going to go higher, but there is certainly more volatility in gold. If you want something where you preserve capital, I would say put it into a short-term treasury mutual fund. You get, almost 5% today on a short-term treasury. That's pretty good.
You mentioned crypto, and as we're wrapping here, I just want to get a few thoughts from you since it's the first time you're speaking to my audience. I know you haven't hid your disdain for cryptocurrencies, but one thing I want to bring up is a lot of Bitcoiners, the believers, rejoicing now, pointing to what's happening in the banking system, showing this is the reason you should be owning Bitcoin. You're outside of the system. You're free from all this. What's your response to the Bitcoin maxis here?
I disagree. I mean, first of all, Bitcoin has a huge amount of volatility. Slightly more than a year ago was at 69. These days is between 19 and 20. So it's lost about 80% of its value. The other top 10 have lost more than that. So you have a huge amount of market risk. You can wipe out your wealth in it. Secondly, we're talking about Silicon Valley Bank, but guess what? In the last week, two major crypto banks went bust, Silvergate and now Signature Bank, because they were, again, doing toxic stuff. And people who had their deposits may or may not be bailed out, but it's highly risky. So, the lesson of the last year and a half has been that anything crypto is extremely dangerous. There are so many crooks, so many frauds. SPF and FTX is not the exception, is the rule. It's a world of con men, criminals, crooks, tax evaders, con men of various sorts. And this entire crypto house of cards is collapsing. So if you want to have safety of your wealth, the last place you want to be is in crypto.
I'm going to let you bring it home for us now. Like I said, it's easy to get lost in all the noise right now, which feels like a pressure cooker of news. So your advice for the people watching this, how can you stay kind of clear-headed, focused, and not get lost in all this?
Well, you have to realize we live in a world in which there are major economic, financial, monetary, political, geopolitical, and technological risks. So traditional investments like 60-40 or variants of it don't work. You have to think about how you protect your wealth in a world in which inflation is going to be higher. As I pointed out, short-term treasury, tips, gold, precious metals, probably even some of the green metals, and sustainable forms of real estate have been historically the assets that provide you a hedge against this type of volatility. And of course, there is a massive technological disruption, AI, machine learning, robotic, automation, quantum computing and so on are going to completely disrupt not only traditional industries, but they can also disrupt some of the big tech companies. Right now, Google feels the threat coming from, say, OpenAI, and how a chat box like a ChatGPT could even replace a traditional search engine. So there'll be massive technological disruptions. Even blue chip firms that are in NASDAQ or in S&P may be disrupted and so on. Of course, the average investor doesn't have access to the kind of VC investments in some of these firms. Many of them are not yet publicly listed, but there are ways in which you can indirectly expose yourself. If you buy Microsoft, you have exposure to, say, OpenAI and things of that sort. So you have to think really that we live in a world of unexpected, unusual, and unprecedented uncertainty, and everything is going to be disrupted. Jobs are going to be disrupted, investment are going to be disrupted, firms are going to be disrupted, technologies, entire firms and countries, and therefore you have to think holistically where you put your money. If we're going to have a war with China, China is going to become uninvestable. If and therefore you have to stay away from China. I mean, a firm like Tesla, they're delusional, believing that they can stay in China. They have to get out of there, like most US firms will have to get out of there, because it will be on a collision course. So you have to think about where you invest your money, domestically and globally, in which sector, in which industries, in which countries. There'll be massive disruptions in the next decade.
That is a tall task, Dr. Roubini. A lot of serious homework needs to be done.
Yeah.
Thank you so much for your time. Nouriel Roubini, author of Mega Threats, 10 Dangerous Trends That Imperil Our Future and How to Survive Them. Thank you so much. I thoroughly enjoyed our conversation today.
My pleasure being with you and with your audience. Thank you.
And be sure to stay tuned to the Daniela Cambone Show on Stansberry Research and sign up at danielacambone.com so you can stay on top of it all. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.